Market crashes wipe out fortunes. But what if they could build yours instead? For generations, we've been taught to fear volatility, to brace for impact, and hope our diversified portfolios can weather the storm. But that's old world, reactive thinking. In the new world, the one being built right now by artificial intelligence, economic shocks aren't just survivable, they're predictable, manageable, and most importantly, profitable. I'm going to show you the core AI technique that the most sophisticated investors are using to turn economic shocks into their single greatest asset. This isn't about complex coding or needing a PhD in mathematics. This is about a new way of thinking, powered by tools that are now more accessible than ever. Stick around, because what you're about to learn will fundamentally change your relationship with money and markets forever. Like and subscribe to the Wealth Saga channel to master your financial future. Let's get started. Section 1. The Great Failure of the Old World. For decades, the playbook for building wealth seemed deceptively simple. Work hard, save diligently, and invest in a diversified portfolio of stocks and bonds. Financial advisors preached this gospel, showing us colorful pie charts that promised safety in numbers. The core idea was modern portfolio theory, a concept that felt solid and reliable. It suggested that by holding a mix of assets that don't move in perfect lockstep, you could smooth out the terrifying peaks and valleys of the market. If stocks went down, bonds would supposedly go up, or at least hold their ground, acting as a buffer for your life savings. That was the promise. And for a while, in a slower, less connected world, it mostly worked. But the world changed. The digital shift didn't just give us smartphones. It fundamentally rewired the global financial system. Information now moves at the speed of light. A single tweet, a rumor on a message board, or an algorithmic trade can send shockwaves across the globe in microseconds. The gentle ebb and flow of the market has been replaced by a series of flash floods and sudden droughts. And in this new, hyper-fast environment, the old playbook is failing. Miserably. Think back to the 2008 financial crisis. The promise was that diversification would protect you. But what happened? As the contagion of fear spread from housing to banking and then to the entire global economy, everything went down at once. Stocks, corporate bonds, real estate, even commodities. The carefully constructed buffers evaporated in a synchronized panic. Diversification didn't just fail to protect. It gave investors a false sense of security right up until their portfolios were decimated. People on the verge of retirement had to go back to work. Fortunes built over decades were erased in a matter of months. Then, it happened again. The COVID-19 crash in March 2020 was one of the fastest and most brutal in history. In just a few weeks, global markets plummeted over 30%. Once again, we saw a flight to safety so panicked and widespread that traditional correlations broke down completely. Investors who followed the old rules were left watching in horror, their portfolios bleeding red day after day. They were passengers on a plane in extreme turbulence, strapped in and hoping their outdated strategy could land the plane safely. Most couldn't. The fundamental problem with these traditional strategies is they are entirely reactive. They're designed to absorb a punch, not to see it coming and get out of the way, let alone use the opponent's momentum against them. Buying and holding through a 40% drawdown means you need a nearly 70% gain just to get back to where you started. That can take years, precious years of lost compounding. In an era where AI is creating unprecedented wealth, sitting on the sidelines just to break even is the new definition of going broke. This isn't just about massive, once-a-decade crashes. Consider a hypothetical future scenario, a major tariff storm where geopolitical tensions create massive, overnight uncertainty. Traditional investors would either panic sell or hold on and pray. Businesses would scramble to reconfigure supply chains, and fear would grip the market. Yet, even in that chaos, certain companies would not just survive but thrive by using technology to adapt faster than their competitors. The old world of investing is a world of hope and fear. You hope for the best and fear the worst. You're a passive observer. The new world, the world of AI-driven finance, is about strategy and opportunity. It's about transforming from a passenger into the pilot. It's about having a system that doesn't just endure volatility but actively seeks it out, because it understands that moments of maximum fear are also moments of maximum opportunity. The greatest transfers of wealth in history always happen during chaos. The question is, will you be a victim of that chaos, or will you be the one leveraging it? The answer lies in the weapon the world's smartest minds are now deploying. Section 2. The secret weapon. The AI resilience engine. So, what is this secret weapon that turns market crashes from a liability into an asset? It's not a single stock tip or a magical algorithm. It's a system, a new way of interacting with financial markets. I call it the AI resilience engine. The best way to understand it is to imagine you're the CEO of your own personal hedge fund, your Fortune Incorporated. In the old world, your staff was maybe a financial advisor who read the Wall Street Journal. In the new world, with the AI resilience engine, you have a team of thousands of tireless, hyper-intelligent specialists working for you 24/7. Let me introduce you to your new team. First up is your head of quantitative analysis. This AI sifts through trillions of data points every second. Every stock tick, every trade volume, every economic indicator released anywhere in the world. It's looking for patterns and anomalies no human could ever spot. Next, you have a chief behavioral psychologist. This AI specializes in market sentiment. It doesn't just read the news, it inhales it. It analyzes millions of news articles, social media posts, and forum discussions every day. Using advanced natural language processing, it doesn't just see if sentiment is positive or negative. It understands nuance, sarcasm, fear, and greed on a global scale. It tells you when market fear is rational and when it's an emotional overreaction, creating a temporary sale on high-quality assets. Then, there's your director of geopolitical strategy. This AI is trained on global events. It monitors election results, tracks supply chain disruptions through satellite imagery, and analyzes new legislation. When a tariff is announced, it doesn't just see a headline. It's already modeling the second and third order effects, which companies are dependent on certain supply lines and which competitors stand to benefit. Finally, you have your lead investigative journalist. This AI digs into the deep corners of the Web4 alternative data. It tracks corporate jet flights, monitors job postings, analyzes employee satisfaction reviews, and even gauges foot traffic at stores through anonymized cell phone data. It's finding the on-the-ground truth that often precedes official numbers by weeks or months. This entire team, the quant, the psychologist, the strategist, and the journalist, is your AI resilience engine. They all operate on one core principle: building anti-fragility into your fortune. Something that is resilient just withstands a shock. But something that is anti-fragile actually gets stronger from the shock. A crisis makes it better. The AI resilience engine is designed to make your portfolio anti-fragile. This isn't just a trading bot. Simple automation is the old way. This is a strategic intelligence partner that embeds predictive capabilities into your financial strategy. It's about changing the question from, what if the market crashes? To, I am prepared for the market to crash, and I know exactly what I'll do when it does. This system turns volatility from your worst enemy into your most powerful ally. Section 3. How it works. A 7-step guide to building your AI resilience engine. This all sounds incredibly powerful, maybe a bit intimidating. But you no longer need to be a Wall Street institution to use these strategies. The tools are getting more accessible every day. Let's break down exactly how you can start building your own AI resilience engine. Step 1. The foundational mindset shift. Before you touch any technology, the first step happens between your ears. You have to stop seeing a market crash as a catastrophe and start seeing it as a sale. Every great investor, from Warren Buffett to Baron Rothschild, has understood this. Rothschild is famously credited with saying, "The time to buy is when there's blood in the streets." Buffett's mantra is to be fearful when others are greedy, and greedy when others are fearful. This is easy to say but incredibly hard to do. When the market is in free fall, every instinct tells you to sell. This is where the AI becomes your ultimate partner. It has no emotions. It feels no fear. It operates purely on data and the rules you set. Your job is to trust the system you're about to build more than you trust the panic in your head. Step 2. Curating your data universe. An AI is only as smart as the data it learns from. Your next step is to feed your AI resilience engine a diverse diet of high-quality information. This includes core financial data, real-time stock prices, trading volumes, and historical data, plus corporate fundamentals like revenue, debt, and cash flow. And macroeconomic data, information on inflation, unemployment, GDP growth, and interest rates. This provides the context for market movements. Sentiment and news data. This is where your behavioral psychologist AI gets its power. You can connect to tools like IBM Watson's Natural Language Understanding or Google's Natural Language API that analyze text and score its emotional content with incredible accuracy. Alternative data. This is your secret edge, the data the average investor never sees. It can include satellite imagery to track cars in a parking lot, credit card transaction data to see real-time sales, or shipping manifests to track trade flows. While once exclusive, more of this data is now available through specialized platforms. Your goal is a rich, multidimensional view of the world that your AI can use to see connections invisible to everyone else. Step 3. Choosing your AI toolkit. Now for the tech itself. You don't have to build this from scratch. For the non-coder, this is where the real revolution is. A new generation of no-code AI platforms is making this power accessible to everyone. Platforms like Magnify let you ask complex financial questions in plain English. Tools like DanElfin provide a daily AI-generated score for stocks, estimating their probability of outperforming the market. Conversational agents like Bobby by Rockflow can help you construct and backtest a portfolio based on your goals. For the technical investor, if you have some technical skill, you have even more options. Platforms like TrendSpider use AI to automate complex technical analysis. For the more advanced, there are platforms like AlgosOne which bring institutional-grade algorithmic trading tools to retail investors. The cutting-edge Agentic AI. The most advanced form is the Agentic AI system, where a team of specialized AI agents collaborate. One agent might monitor news, which then tasks another agent to analyze the impact, which then triggers a third to scan for undervalued stocks. This is the future, and the platforms enabling it are emerging now. The excuse, "I'm not a tech person," is no longer valid. The tools are available at every level. Step 4. Parameterisation, giving your AI its mission. An AI isn't a mind reader. You have to tell it what you're looking for. This is where your personal strategy comes to life. You set the mission for your AI team. This involves defining your opportunity criteria. For example, at the trigger, the S&P 500 must drop at least 15% from its 52-week high. At the quality filter, only look at companies with a market cap over $10 billion, low debt, and a history of positive free cash flow. This filters out weak companies. At the value filter, the stock must be at least 30% below its 200-day moving average, ensuring you're buying at a significant discount. In the sentiment filter, look for stocks where news sentiment is extremely fearful, but sentiment around the company's actual products remains positive. This helps distinguish between market panic and a genuinely broken company. Your parameters will reflect your unique risk tolerance. This is how you embed your own intelligence into the AI. Step 5. The simulation engine, backtesting for confidence. Before you deploy a single dollar, you must test your system. This is done through backtesting, running your AI resilience engine on historical data to see how it would have performed in past crashes like 2008 and 2020. Did it buy too early? Did it filter out the value traps? How did the portfolio perform 1, 2, and 5 years later? Backtesting isn't about guaranteeing future results. It's about refining your parameters and building confidence. You wouldn't want a pilot flying a new plane without thousands of hours in a simulator. Don't fly your portfolio without one either. We're getting into the core of the strategy now. If you're finding this breakdown valuable, do me a favor and hit that like button. And make sure you're subscribed to the Wealth Saga channel, because we go deep on actionable strategies like this every week. It's the best way to support the channel and ensure you don't miss what's next. Step 6. Interpreting the output, the human-AI collaboration. So, the market is crashing, your AI engine is triggered, and it starts generating signals. Well, now, this is the part people often get wrong. The goal isn't to create a black box that you blindly obey. The goal is to create a powerful decision support tool. A well-designed system won't just spit out a ticker symbol. It will give you a complete dossier. Signal identified, XYZ Corporation. It meets 95% of your quality criteria after a 42% drop. Our sentiment analysis shows extreme market panic, but our alternative data shows their factory output remains stable. Geopolitical analysis suggests their main competitor is being hit harder. Here's the bull case, the bear case, and a confidence score of 85%. Your job as the human in the loop is to take this incredible, synthesized research and make the final call. The AI handles the tireless data work humans are bad at. You handle the final qualitative judgment that humans excel at. This combination is the ultimate advantage. Step 7. Execution and dynamic rebalancing. Once you decide to act, you execute the trade. But the work isn't over. Your AI resilience engine keeps monitoring the position and the market 24/7. It will alert you if the fundamental reasons for owning it change. It will also help with the exit strategy. Based on your parameters, it might be programmed to start trimming the position after it has recovered 100% or when its valuation gets too high. It enforces discipline on both the entry and the exit, which is where most investors fail. Building this engine is a process. You'll start small, learn, and refine your system over time. But these 7 steps are the framework for turning chaos into your greatest strength. Section 4. The AI Resilience Engine in Action, 3 case studies. Theory is one thing, but let's see how this would work in practice. Case Study 1. The COVID-19 crash, March 2020. The scene, global panic. The S&P 500 plummets over 30% in weeks. The old world investor is either selling everything or frozen in fear. The AI resilience engine is in its element. Trigger, the 15% market drop threshold is breached. The engine activates. A data analysis. The sentiment AI sees unprecedented fear. However, it also analyzes government and central bank announcements, detecting a massive commitment to stimulus and modeling a high probability of a swift, liquidity-fueled recovery. Filtering, the engine scans for opportunities. It immediately discards airlines and cruise lines that fail its strong balance sheet test. It focuses on high-quality companies being sold off indiscriminately. Signal generation, it identifies a company like Microsoft. The dossier, Signal, Microsoft, dropped 25% with the market. Our data shows its cloud division, Azure, is seeing a surge in usage from the shift to remote work. The fear is macro-related, not company-specific. Balance sheet is a fortress. Confidence score, 92%. The human in the loop, you review the dossier. The logic is sound. While others panic sell, you accumulate a position in a world-class company that is structurally benefiting from the crisis. The result, a position like this would have produced extraordinary returns, far outpacing investors who waited for an all-clear signal that never came. Case Study 2. Hypothetical, a future tariff storm. Let's imagine a future scenario. A new wave of protectionist tariffs is announced, sparking fears of a global trade war. The old world investor just sees a reason to avoid stocks. The AI resilience engine sees a complex puzzle to solve. Trigger, widespread sector volatility triggers an analysis. Data analysis, the engine's geopolitical AI maps out entire supply chains. It scrapes customs data and cross-references company reports to determine their dependency on foreign suppliers. Filtering, the AI would be built to find precisely these kinds of resilient companies. It specifically looks for companies that have either A, diversified manufacturing outside the tariff zones, or B, such strong brand power they can pass costs on to consumers. Signal generation, it identifies 2 types of opportunities. Company A, the pivot signal, a high-end electronics maker. They've been shifting production to a new factory in an unaffected country. Our alternative data confirms this factory is operational. The market is pricing this stock as if its margins will be crushed, but our model shows a minimal impact. Confidence score, 88%. Company B, the powerhouse Signal, a dominant luxury goods company. Its high-income customer base shows zero price sensitivity. They can absorb the tariff, raise prices, and customers will still buy. The stock has been unfairly punished. Confidence score, 90%. And the result, the AI engine allows the investor to see past the headline fear and identify specific companies with resilient operations, turning a macro threat into a micro opportunity. Case Study 3. The future, navigating with agentic swarms. Now, let's look forward at how collaborative, multi-agent systems will work. The scene, it's 2028. A disruptive new technology emerges, threatening the entire transportation industry. The agentic swarm activates. Agent 1, the scout monitors scientific papers and patent filings, and is the first to detect the new tech. Agent 2, the scout tasks the analyst to assess the vulnerability of all public companies in the sector by analyzing their R&D spending and patents. Agent 3, the analyst passes its findings to the financier, which evaluates the financial health of the most adaptable and most vulnerable companies to find long and short opportunities. Agent 4, the financier tasks the Sentinel to perform real-time sentiment analysis on the shortlisted companies, looking for a gap between market perception and reality. The dossier, the swarm presents you with a comprehensive map of the industry disruption. Here are the 3 companies poised to dominate. Here are the 5 most likely to go bankrupt. Here is the optimal time to enter these positions. This is the future of investment research. A team of specialized intelligences working together to provide an unimaginable level of insight. Section 5. Addressing the what-ifs, overcoming your doubts. You're likely feeling a mix of excitement and skepticism. That's natural. Let's tackle the most common questions head-on. This sounds amazing, but do I need to be a coder or a data scientist? An emphatic no. 10 years ago. Today, the biggest revolution in AI is accessibility. An entire industry of no-code platforms has emerged for this exact purpose. Tools like Magnify and Dan are designed to be used with plain English and intuitive interfaces. If you can use a search engine, you have the skills to start. The barrier is no longer technical, it's the willingness to learn a new tool. Isn't this just for millionaires and hedge funds? That's an old-world myth. While hedge funds have massive resources, the playing field has been leveled. First, the cost of these tools is plummeting, with many offering free tiers or affordable subscriptions. Second, with commission-free trading and fractional shares, you don't need huge amounts of capital. You can start with a few $100s to learn and gain confidence. This is no longer a game reserved for the ultra-wealthy. This feels risky. What if the AI gets it wrong? Let's reframe that. What's the risk of not adapting? Sticking with an outdated strategy is arguably far riskier. The AI resilience engine isn't about wild speculation, it's about intelligent risk management. It's about replacing emotional, gut-feel decisions with a systematic, data-driven process. And of course, no system is perfect. That's why the human-in-the-loop principle is critical. The AI is your analyst, not your guru. You make the final, informed decision. The goal isn't to be right 100% of the time. The goal is to be right more often and to make sure your wins are bigger than your losses. I've heard about AI hallucinations. Can I trust the output? A valid concern. It's important to distinguish between a creative AI like ChatGPT and a dedicated financial analysis AI. Platforms for finance are built on verifiable, structured data. They aren't creating facts, they're analyzing them. A good platform will also be transparent, showing you the data that led to its conclusions so you can verify its reasoning. You trust the process of data-driven inquiry that the AI enables. Okay, I'm convinced. But where do I even begin? It feels overwhelming. The best way to climb a mountain is one step at a time. Here's a simple, 3-step plan. Educate yourself continuously, You're already doing it. Dedicate time each week to learning about this space. Follow channels like this one and stay curious. Pick one tool and experiment. Don't try to master everything at once. Choose one of the beginner-friendly tools we discussed, maybe one with a free trial like Dan Elfin. Get a feel for the interface. The goal isn't to make money yet, it's to learn. Start small. Once you're comfortable, allocate a small, experimental amount of capital to the strategy. This should be money you can afford to lose. Track its performance. This real-world experience, even on a small scale, is invaluable. The journey from the old world to the new doesn't happen overnight. But it is a journey you must begin. We started with a question: what if market crashes didn't have to wipe out your wealth? By now, you know the answer lies not in fear, but in preparation. Not in hope, but in strategy. Future-proofing your fortune in the age of AI isn't about avoiding downturns. It's about reframing them as the greatest opportunities you'll ever get to buy quality assets at a discount. It's about building a systematic, data-driven engine that is immune to the emotional roller coaster of fear and greed. It's about leveraging the most powerful technology humanity has ever created to serve your financial goals. The tools are here. The data is available. The knowledge is accessible. For the first time in history, the same caliber of analytical power used by the world's top hedge funds is within your grasp. You no longer have to be a passive victim of market cycles. You can become an active architect of your financial future, turning volatility into your ultimate advantage. The only thing missing is your decision to begin. Thank you for joining me on this journey. The power to master your financial future is in your hands. If this guide has opened your eyes to what's possible, show your support by hitting that like button. And to get the latest strategies for this AI-driven world, subscribe to the Wealth Saga channel and ring that notification bell. We're on this path together. Master your future.